Welcome back, ladies and gentlemen, to another Mining Stock Education Expert interview. I'm Bill Powers, and I'm speaking today with Sam Broom, an investment executive with Sprott Global since the early 2016. In March 2017, I first learned of Sam via a YouTube video that Sprott published with Sam sharing regarding the bullish case for cobalt. I've asked Sam to come on the program and share regarding his approach to natural resource investing and where he sees the best opportunities right now. So Sam, I appreciate you joining me.
Bill, thanks for having me. Appreciate it.
Sam, could you begin by giving a little background about yourself and sharing with listeners your personal investment journey and how you came to be an investment executive at Sprott?
Sure, yeah. My story is one of those textbook, right place, right time kind of stories. I actually started my professional career as a geologist. Started in New Zealand, my homeland, and ended up moving to Australia, where I worked in the mining sector for a number of years. And then, the bear market took hold, and for personal reasons, I ended up moving to the US. So while I was waiting for my green card to arrive, which was about a year or so, I had a chance encounter with a Sprott broker while playing beach volleyball down at the beach, of all things. And, I ran a little investing blog at the time, and obviously I had a geological background. This broker was looking to bring on someone to help him out. And so that's how I got my start. And that was, early 2016. And the rest is history. And, I've really relished the opportunity to work with Sprott, who is obviously, in my opinion, the best in the business. And it's been a real dream come true for me.
Your investing blog, it was thenudeinvestor.com, and that's also your Twitter handle. So what's behind that moniker?
Yeah, people often ask that. I guess it was a little, play on words with the bare essentials of investing. There was a famous. I'm a bit of a chef in my spare time. And there's a famous chef called the Naked Chef out of the UK, Jamie Oliver. So it was inspired by him. So. But yeah, that's the history behind that one.
So when you look at your approach to natural resource investing, how would you describe your approach to natural resource investing?
Sure, yeah. Well, I think the first thing to realize is, investing is not an exact science. So I like to follow sort of a three-pronged approach to my investing and what I like to invest in. First of all, I think if you're going to be in the natural resource space, you've got to have an eye on the macro situation. Anyone that's been in the natural resource markets for any length of time knows that it's about as cyclical of an industry as you can get. So if you're piling in at the wrong time, even the best investor in the world is going to struggle to make a decent return. If you came in at 2011 or 12, you probably have had nothing but a negative experience in the sector since then. However, if you come in at the right time, and it's always difficult to know exactly where you are with any certainty, but you can get a fair idea from studying history and looking at charts and following a little bit what's going on. When's at least a reasonable time to come back in the market. Right now, I think, is one of those times. We can probably touch on that later. So firstly, I try and keep a reasonable following of the macro situation and what's happening in the world and what's happening with the cycles and where we are. Second of all, I think it's really, really important to understand the companies that you're investing in. The mining sector there's a whole spectrum of quality of companies, just like there is in any sector. My personal approach is that I like to stick with only the very, very best in each sort of category, whether it be optionality plays, whether it be junior exploration companies, whether it be producers. I try and figure out where I think the very, very best are. I don't try and play with the super short-term, trade ideas. And lastly, it's a little bit of a dark art form, but I am a big fan of technical analysis because I do think a lot can be derived from a chart. Charting is a history of price action in a stock, and it shows you when people are buying, when people are selling, and when the mix of buyers to sellers is changing. So what I really use technical analysis for is to figure out the best time and obviously with a bit of grace, to be buying stocks and when things are looking a little overvalued and ready to be sold. And I find that's particularly useful in the mining and in the natural resource sector, because there's probably the least amount of algorithmic trading and basically computers and bots that distort things, because it's a relatively small sector. So I actually do find technical analysis to be very useful. So what I generally try and do is combine all three of those. So fundamental, macro, and technical analysis. And when I'm getting a buy signal on all three of those things, that's a pretty powerful thing. So the more you can combine, the better, given that, like I said, investing isn't an exact science. So that's basically what I use to help guide my investing decisions.
When it comes to your natural resource investing approach, what are the biggest investor mistakes that there is to avoid?
Sure, yeah. It's a bit of a minefield out there for newbies in particular. I think one of the key things you need to avoid, and if I look back to my early career in the sector, is falling in love with the stock. How many times you meet people that they just can't let go of something, it's not working out. They'll rationalize why it's not working out, when the best thing to do was probably to sell when the fundamentals or whatever changed. So I would say, number one, avoid falling in love with stocks, and try and keep as objective as you can on the positions in your portfolio. The second thing I would suggest you want to avoid is trusting hype. So, whether you're on the message boards or reading newsletters or whatever you're doing, chances are the things you're going to hear the most about are the hypiest, the most promoted stuff. So unless you're in those things really early, probably before you hear the hype, your chances of getting burnt, particularly if you're not in a raging bull market where everything's going up, is pretty high. So if you're hearing about something and the stock's already up 200, 300, 400%, just be very, very cautious, because chances are you're hearing it last and you're going to get burnt. So the last thing, the biggest mistake to avoid, I would say, is not to have any risk management in place. So depending on where within the natural resource space you're investing, that will, the risk management measures you can employ will differ. If all you do is invest in the junior space, it's hard to use things like stop losses, because the liquidity in these positions are so poor that you can't be sure of your stop loss measures working and things like that. So your real weapon is position sizing. You don't want to have too much, no matter what your conviction is, of your entire portfolio in a single junior name. That's just lesson number one. If you're in slightly more liquid names, so your larger sort of single asset development stage companies through to your mid-cap producers and majors, where there are decent trading volumes, you can be a little bit more secure in using things like stop losses. The real key is to have some idea of the level or something, some sort of trigger, whether it's a price point, whether it's a fundamental event or something like that, where you're willing to get out of a trade and admit defeat and say, yep, this one didn't work out. Because too many people buy into things, and either the story changes or they didn't fully understand the story when they got into a position, and they fall in love and they don't get out. So you need to have some kind of risk management with your investing and your trading.
Sam, before we talk about where you see the best opportunities in the natural resource space now, I'd like to ask you a question from the perspective of a North American investor that potentially would be looking to invest on the Australian Securities Exchange. One of the biggest objections I've heard from North American mining stock investors is that if they were to invest in the Australian Securities Exchange, they're getting their news, a day late, and the Securities Exchange is open when they're sleeping. What would be your response to someone with that perspective?
I would say that that's probably the only valid argument against the Australian exchange. I'm probably somewhat biased because it's the exchange I know the best from my past, but looking at the performance, and I would say the outperformance of the Australian sector, it's been pretty spectacular. I'm actually halfway through writing a Sprott's thoughts about this very topic. So for those listening, keep a lookout for that. Yeah, that is one issue. I would say, depending on what you're investing in, if you are investing in things where they're likely to be news flow, that you're going to need to know that very second, it can be a problem. But I would argue that, the best investment opportunities, you're not going to see one-off news events that really dramatically change the story that much. The one exception is probably these junior exploration stocks where drill results come out and you want to be able to get in or out then and there. My response to that would be, if you've got a discount internet broker that allows you to trade 24/7, the Aussie market's not really when you're asleep. If you actually look at the time zone, I mean, perhaps if you're on the East Coast, it might, of the US, that might be the case. But for example, right now, the Aussie market opens at 3 p.m. Pacific time and closes at 9 p.m. Pacific time. So I'm watching my clients and my own positions, when I get home in the evenings on my app on my phone. East Coast, that's going to be 6 to midnight. So it's not middle of the night type stuff. So as long as your broker's got access to trading 24 hours a day, I don't think that's a valid argument. If you can't trade the market whenever you want, you've just got to be a little selective in what I was saying before, your risk management. Make sure you don't have too much in one name, especially the junior stuff. In the bigger names, you can use things like stop losses and things like that to help you out on that one.
Moving over to the macro trends in the natural resource sector, on January 9th, you tweeted a theme that doesn't get a lot of speculative attention, agricultural commodities, which is one of your top 3 sector picks for 2018. Can you share a little bit about the agricultural commodities and why you're bullish on them?
Yeah, sure. It's really simple. I like to keep things simple when I look at the macro side of things, because I think if you bog yourself down trying to figure out all the little nitty-gritty intricacies of the global economy, you're just going to trip yourself up. But if you go look at a chart of, most commodities, so if you look at the things like the Bloomberg Commodity Index, you will see that most commodities, whether it be base metals, precious metals, oil, even things like uranium, they've started to put a base in, and some have even started to move quite a bit higher. About the only thing that's still undervalued is agricultural commodities. Obviously, it's a very broad sector, and there are exceptions within that. However, across the board, they're about the only thing that hasn't moved at all yet. So based purely on a relative basis, and the fact that we know commodities move in these clear cycles, and within that, the agricultural commodities are the most cyclical of anything. There really is a case to be made to have a reasonable allocation towards the agriculture sector. I'm still trying to figure out the very best way to do that. There are certainly some interesting companies out there. But yeah, it's a sector I really think people should be looking at in 2018 and beyond.
And what's your perspective on the agricultural fertilizer commodities?
They're certainly dirt cheap, that's for sure. Look, I try not to catch a falling knife. I do like to see signs of a rebound. We haven't quite seen that in a lot of these plays, but they certainly do look deep value here. So I'm watching them very closely. The fertilizer play, the potash plays are certainly on my radar, put it that way.
After agricultural commodities, you mentioned in this tweet that you had 3 top sectors. So what would be your other 2 sectors, or did you already reference them?
Yeah, so ag's is certainly one of them. I've gone very, very bullish towards the precious metals sector this year. For those that are my clients or read the material I send out, I was favouring the base metal sector in 2017, which turned out to be a good one. But I think this year we're really going to see precious metals break one way or the other, and I strongly believe that it's going to be to the top side. So I'm really, really long gold and silver, primarily gold, but silver's probably going to outperform if we really do see a bull market. So that would be one place I would be heavily invested in 2018. The other place I'm fairly heavy at the moment is the battery leveraged base metals. So that's primarily nickel's my absolute favorite at the moment. Cobalt I was long on about 12 to 18 months ago, and that's done really well, and I remain bullish there. But it has had a really good run, so that's why I favour nickel over cobalt probably at this point. And then the last one is copper, which I think is kind of like your investment grade base metal. And I think regardless of what happens, what technology takes to the forefront of the battery sector, you're guaranteed to have increased copper demand at a time when you've got declining production out of the copper sector, declining grades, declining throughput, et cetera, et cetera. So I think nickel, cobalt, and copper are going to do really well this year.
But you would even choose, if you had to choose, you would choose nickel over copper. I recently listened to two fund managers talk, and they both said the safest bet for the battery metals bull market would be copper because of the electrification of not just the vehicle, but also all the corresponding infrastructure.
Yeah, that like I said just before, I view copper more as the investment grade commodity. So if you're wanting to be a little bit less risk averse, but you still want exposure to something that's going to have very strong leverage to growth and electrification of the world, I would go for copper. For those that want potential, slightly more speculative theme, I would take a look at nickel. If you just look purely at its, on a relative basis to where it's traded in the past, the nickel price is still down 75% or more from its 2007 peaks. So, I don't think it's going to get back to new highs. I will say that, but I do think it's got a long way to go from where it is now. I think the rise in the nickel price has got a long way to go. Although I will preface that by saying I think it's going to be volatile on the way up because there's a lot to work through from oversupply and from the past years and big stockpiles and things like that.
With your geological background, do you tend towards those exploration and development stocks over the producers in terms of where you like to research and put your investments? It depends. For clients anyway, depends on their risk tolerance and things like that. Given my macro view right now, I kind of see us being sort of mid-early stage, i.e. still early stage in a commodities bull market. I tend to think that the juniors tend to do better when everything is rising in tandem and there's euphoria and money is flying into the sector. So mid to late cycle. I tend to think we're early to mid cycle in this next bull market. So right now I'm focusing a lot on the highest quality single asset development stage companies. So that is juniors that found something significant and are in development stage because there's very little in the pipeline for most of these commodities in terms of new projects. So I think a lot of these, tier one discoveries that are being developed are going to get taken out in the next sort of 12 to 24 months. On top of that, I really like the lean, mean mid-cap producers with really nice growth profiles. There aren't a lot of them, but the ones that do exist are still very cheap, in my opinion. So that has been my other focus at the moment is finding these high growth, high quality, relatively low debt mid-cap producers, whether it be in the gold or the copper space in particular. But I do have quite a large junior exposure here, but I'm very selective about the companies. I'm really selective about the juniors that I'm in at the moment. And I will be moving down the food chain into the juniors a little more as this bull market progresses. I should say as and if. Nothing's guaranteed in this sector, but I do believe we're in the early stages of a bull market, and as that bull market matures, that's going to be the time to really transition into the juniors. I'm talking with Sam Broom, an investment executive with Sprott Global. And Sam, before you go, I'd like you to share your contact information with the listeners. If you're looking for a full-service, knowledgeable broker, Sam is an individual that can help you steer your investments and also help determine investment opportunities for you. So, Sam, before you go, could you share any concluding thoughts and how listeners can reach out to you? Yeah.
So, if you're an investor and you're looking for someone with expertise to help you make the very best decisions as far as your natural resource portfolio goes, by all means get in touch with me, and I can certainly talk to you about how I might be able to help you out. My email address is sbroom, so that's SBROOM @sprottglobal.com. I'm more than happy to talk to you. Please note that for compliance reasons, I can't give any investment advice or stock picks to anyone that's not a client. So just note that ahead of time. I would also follow me on Twitter if you were interested. I occasionally tweet on there. As was mentioned earlier, my handle is @thenude_investor. So it's pretty memorable, that one. But yeah, apart from that, I'm more than happy to hear from you, and I hope you found this interesting.
Sam, I appreciate your time. Thank you for joining me.
Thanks, Bill.
Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at MiningStockEducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.